Okay, I'll give you a minute to get settled, and we're picking up on the defined benefit plans and the components that make up pension expense. And I know Professor Jeffries had some of you in a class when the DFAS came around, but if you want information out of there, hiring interns and then interns for general job, get like the first chance at job. If you want to look at it, you're welcome to.
You felt help was looking up earlier. You add up all the benefits that go along with the journey. As good as 20K to pay. Like starting out 90K.
So you just take one, if you don't, each, if not, you just pass them. You can just leave it there. So, you were probably in this class, so you probably can't, but if you want. But that's the, we have. There's also some extra, if somebody's writing, you want, somebody's available here. We're still on handout number 9. And as you can see, I put in service cost, interest on the pension, benefit obligations, amortized. You don't really need to write that stuff in. I had a picture in there, but they said to try to save some space, so trying to save printing and space. Okay, so we're talking about service cost. Service cost is the expense caused by the increase in pension benefits payable. We call that, right, the pension benefit obligation or projected. I thought it was pension, but they put projected. This book keeps changing stuff on me every year and it stays the same version. Like you need to make it B or C. To employees for services during the year. And I'll give you time to write that. I know it takes longer to write it than type, so please take a minute. Okay, interest on the liability. This is the interest expense that accrues each year on the PBO.
Actual return on plan assets is the return earned by the accumulated pension fund assets. Within a particular period. This reduces pension expense unless the return is negative. These are pension plan amendments, including the initiation of a pension plan. That can increase or decrease benefits for employees that provided service in a prior year. Or years. Benefits of which are expected to be recognized over the future service of the affected employees. Gain or loss is changes in the fair value of plan assets or projected benefit obligation. Any questions about the components? All right, so let's go ahead and take a look at example 1, and I will walk you through this in a minute. Okay, so we want to take each of those pieces that we have and include them here. So we have service cost, and that service cost, they tell us, is $250,000. So we have $250,000. our interest cost. We have to calculate it. We have the projected benefit obligation of 2.6 million on January 1. So we take PBO times the rate, and that equals 2.6 million times 0.08 or 8%. That interest or discount rate is there. And that multiplies out to be 208,000. Here we have actual and expected return on plant assets. And this one reduces the expense, so 65,000. And that figure hopefully printed out okay on yours, a little cut off on mine, but that's there. Yeah, I didn't make the boxes the right size for the text. Okay. And then you have prior service cost amortization. And in this case, prior service cost amortization increases our pension expense. And so that's 40,000. So our total pension expense for 2025, we add those up and I get 433,000, or at least that's what the answer key says. Okay, excellent, thank you. All right, and part B says, prepare the journal entry to record the pension expense and the employer's contribution to the pension in 2025. So we have to look and see what they contributed. So that's 230,000. We know that's going to be a credit to cash, right? Because that's how we contributed it. So we have pension expense. And that's the 433,000. And then we have cash, 230,000. Other comprehensive income for 40,000. And the difference here is going to increase our pension or asset or liability. So pension asset / liability in the liability direction for 163,000. This 40,000, the prior service cost amortization, it's a component of that has to, well, it builds in there and you don't really reverse it out unless it gets too large. When we talk about the quarter approach, what it does is, and I forget the exact formula, but it either takes a percentage of your obligation or a percentage of your assets. And if it gets bigger than those, then it has to be amortized out. But this is just the initial occurrence of that. And since it increased it, it decreases your retained earnings or other comprehensive income. Calculating return on plan assets. So take the ending balance reported by the trust. less the beginning balance reported by the trust. Less contributions. Add benefits paid. And that equals the actual return on planned assets. Once you're done copying that down, you take a look at example 2. Okay, so we have some information related to Woods Inc. for the year 2026. And so they're asking us to calculate the amount of pension expense to be reported for 2026. And it's telling us that the actual return on plan assets also equals the expected return. And so we have service cost. That's 410,000. Interest on PBO. And that they say is 270,000. Now the interest on vested benefits. So they love to throw in these other things that people would like to argue about. And I'm kind of a person that says, put that stuff in the back. Because if it's not GAAP, we don't really need to learn about it, but they have other types of benefit obligations, accumulated benefit obligations that are less. And so essentially this vested benefit thing would be a part of this. And so we ignore the vested benefits because we want the full obligation. And the difference between what's vested and what's likely to vest can be material over a number of years. And so we want to make sure that we're only looking at the PBO. We're not taking vested benefits. We're not taking vested benefits plus the current salary. Pension benefit obligation includes all the stuff that's vested, all of your current salary, plus the expectation that your salary is going to increase over the years if you are part of that pension. So we don't include that. Amortization of prior cost due to increased benefits. That is included, and that's 60,000. And then your return on plan assets. And in this case, this is going to reduce because we have a $90,000 return. And so our total pension expense is $650,000. Any questions? Okay, I'll let you get that down before we jump to example 3. I'm going to test my formula. Okay, so I've copied that formula from up above. I'll give you some time to do that. Because we want to know what is the actual return on plan assets in 2026. So we take the ending balance reported by the trust, is 6.6 million. And we subtract out the beginning balance. And then we have to take out the contributions. We're going to add the benefits paid. $750,000. And that should give us our actual return on plan assets. Which they have is 510,000. Good. I'm going to use the pension worksheet here. You can use the one that's given to you on the sheet there. Okay. So what we have based on the information is it tells us our plan assets at January 1, 2025 are 950,000. That's a debit because it's an asset. Our projected benefit obligation is 950,000, and that's a credit. And I usually put those in as a negative. And so our pension asset or liability is the difference between those. So add them together and we have no net pension liability. What do we call that? Does anybody remember from the text? It's fully funded, right? It wouldn't be underfunded or overfunded. It's exactly at it. Okay, let's look at the service cost. The service cost says it's 75,000. And that's a debit. And we know that that increases our pension benefit obligation or projected benefit obligation. And so that's a credit. Now we're gonna take the interest cost, and what we do is we have to multiply the projected benefit obligation by the settlement rate, so 0.06. And we get 57,000. That's also a debit. It increases our obligation. Our actual and expected return on plan assets is 40,600. That's a credit. And that increases our plan assets. Our contributions are 10,000. So our cash is going to go down 10,000. Don't like these people own my cars. My cash went down 10,000 last month. Gotta fix them though. All right. And this contribution increased the plan assets. So that's a debit. And then the benefits paid. And remember, these only affect the memo part of the entry. And so this is going to reduce what we owe because we paid benefits, 42,200. And that's a debit, but it reduces our assets available, so that's a credit. So our journal entry, we sum these totals up. This is going to be our debit. This is going to be our credit. So now we have to figure out, do we have a liability or an asset? We can see that we're going to have a liability. So these are credits. Credit. And so we have our entry now. And it comprises ones on this line. So we get down here and we pension expense. Credit to cash. And the credit to pension asset liability. We know it's a credit, so it's adding to our liability. Any questions there? All right, let's take a look at example number 5. Okay, so we're starting with this, and you don't always have to draw out this chart, but just to illustrate it. First person we're starting with is Jane, and they have 6 years of service remaining, again, expected. So a year, 25, 26, 27, 28, 29, and 30. And so that's 6. Bless you. Okay. John has 1 year. Jimmy has 3 years. Jenny 6 and Jerry 4. I'm just going to sum across. So we have 5, 4, 4, 3, 2, and 2, and those should add up and down to 20. Now we have to find the cost per service year. And so it says the cost, they're increasing its projected benefit obligation by 210,000. So we have 210,000, and we're going to divide it by our total of 20 service years. And that equals 10,500 per service year. So now you want to find out how much in each year are you going to recognize. So we take our totals for 2025 and we're just going to copy this column over. And our cost per service year is 10,500. We're just multiplying these across. So I get 52,500. This is always going to be 10,500. And we just need to multiply across. So 42,000, 42,000, 31,500, 21,000, and 21,000. And we should make sure that the total equals our 210,000. So we add it up and hopefully we come up with 210,000. Most of the questions will give you the number of service years. They won't have it drawn out like this, but I wanted to illustrate it because I wanted you to see how the long, painful process would be. Just letting everybody catch up here. Easton's got a little bit of the jitters today, so I keep thinking somebody's typing over there. All right. So let's go ahead and talk about this. So we talked about the amortization of prior service costs. When initiating or amending pension plan, a company often provides benefits to employees for years of service before the plan begins. Plan or amendment. Projected benefit obligation is increased to reflect this additional liability, which is often material or large. Amortization. Should the company report an expense for these prior service costs at the time of the initiation or amendment? And the FASB says, nope. I believe so. I think you can find it if you look hard enough. The employer would not provide this benefit unless it expects to receive benefits in the future. Company should not recognize retroactive benefits in the year of the amendment. Give it a second to catch up. If you ever need a little more time, by the way, just give me a little wave and I'll assume you're not saying hello, but that you need more time. So what happens? The employer records the prior service cost as an adjustment. To other comprehensive income. So you debit other comprehensive income for prior service cost. And you credit projected benefit obligation. Employer then recognizes the expense over the remaining service life of the employees that will benefit. And just as the cost of the retroactive benefits, including any benefits to existing retirees is the increase in pension benefit obligation or projected benefit. I keep saying. I think that says that kind of a couple times in there, but just stating things four ways and sideways. Give you guys a couple minutes to catch up, and if I did this properly when you're looking at example 6 next, once you're all caught up, that I'm going to go through, you can kind of open it up and then follow along directly on the right. While you're doing that, I'll get this one set up. Because these are on 2 pages, I know that makes it a little more challenging. If, as I enter any of these, you don't know where I'm getting them from, please stop me and ask, okay? Okay, so the balance January 1, 2025. And it tells us our projected benefit obligation is 1,255,000. And it tells us our plan assets are 1,195,600. No, that's going to be a debit. So now we figure out whether or not we've got a liability or an asset. And in this case, we have a liability. Now it tells us on January 1, 2025, Eagle Home Corp. Through plan amendment grants prior service benefits having a present value of 200,000. So this kind of happens before anything else happens. And so you're still going to have an adjustment here. So prior service cost, 1/1/25. And remember, we're not going to hit the expense this year, right? What are we doing? We're going to carry this over to prior service cost. And that's going to be 200,000 debit. And it's increasing our pension benefit obligation. So that's our credit. Now we have our new January 1, 2025 balance. And so now we have an obligation of it says to leave it at 59,000, but that doesn't sound right. So we're just going to go ahead and do it because that's what they tell us. Okay. We just have to remember that we're going to have to make that adjustment at the end, and it will be picked up. So now we can go through our components, and we have service cost. Our annual pension expense, 69,000. That's a debit. It's increasing our obligation. So that's a credit. And we're going to have our interest cost. And our interest cost now is going to be based on the 1.455 million obligation. And we're going to have to multiply it by the rate, which the settlement rate is 6%, so 0.06. That should not be negative. Got to put the negative in there. And so that's a debit, increases our expense, but it also increases our obligation. And so that's our credit. We have our actual and expected return on plan assets. Remember, this one's going to be a credit. It's going to reduce what we owe. And so that's 43,610. And that's increasing our plan assets. So it's going to be a debit there. And then we're going to have, it says prior service cost amortization. So what they did was they took that 200,000, they made that calculation, they divided it by the number of employees, and they said, we're going to recognize the portion this year related to that cost. And so they report 25,000. So this is 25,000. It increases. So it's a debit. It reduces the prior service cost. So that's a credit. Then we have our contributions. Remember that reduces our cash by 85,000. And it increases plan assets by 85,000. So that's our debit. And then we have benefits paid. And so this reduces our benefit obligation, 52,000. And it reduces our assets that we have to pay, or excuse me, that we have available to pay benefits. And so that's all of our transactions as we go down the list. We check off everything. We don't have anything missing on the table there. And so now we just have to calculate the journal entry. We're taking the net here on the prior service cost. And we're just taking the amortization and putting it together. We're going to have something for pension asset and liability. We don't know what that is going to be yet. So now we need to sum up our assets and our liabilities. We had 3,014,300. No, that's not right. Put an extra zero in there. Oh, I went too far up. Excuse me. Like, whoa, that's not right. Make sure you don't pick up that balance if you've already included it. I get 1,559,300 and 1,272,210. That's my debit. So now my ending pension asset liability needs to be 287,290. To say, okay, where were we before? We were here. I gotta do a minus and then a plus. And we get 227,690, and that's a credit. I don't know what XD is. I must have just mishit the key there. And so now we're going to go ahead and create our entry. And so we have pension expense, 137,690. I want to get the debits here together. Other comprehensive income. And that's 175,000. We have to record the cash contributions. And then we have to record the pension asset slash liability. And that equals the 227,690. Now just a quick check to see, make sure we balance 312,690 and 312,690. Okay, I think here's where we'll cut off for today. And so you guys are free to go, and we'll pick up with the accounting and amortization for unexpected gains and losses in the next class. Thank you for showing up online. I will see you guys on Thursday.